Welcome to the Deep Dive. Today, we're diving into One Up on Wall Street by Peter Lynch. We're going to be looking at investing, like practical advice for everyday investors.
It's funny, Lynch really makes it all seem kind of doable,
Mhm.
without like oversimplifying it or anything. Like, he shows how all that everyday stuff you see and do, all those experiences, can give you an edge in the market.
Yeah, I love that. Like that edge. That's a great way to put it. So let's talk about some of those big ideas. I mean, one of the things he's really into is long-term investing. And that might seem kind of weird, in today's world where everyone wants to like flip stocks overnight.
Yeah, but Lynch, he really like lays it all out. I mean, he really makes the case for it. He shows how stocks have consistently, outperformed other investments over time. He's got this great example. $1,000 invested in stocks way back in 1927, that would grown 15 times more than bonds by 1987
Yeah.
and over 30 times more than treasury bills.
Wow, yeah, that's a big difference. I mean, when you see numbers like that, it makes you think twice about, those get-rich-quick schemes. But what's the reason for that kind of difference in returns?
Well, with stocks, you're not just lending money like, with bonds. You're buying part of a company. I mean, you're a partner. As the company grows and their profits increase, so does your investment.
So it's really about potential versus like those fixed returns. But let's be real, the stock market, it can be scary, right? I mean, the thought of riding out those ups and downs, those crashes, it makes you kind of nervous.
And Lynch gets that. He really does. That's why he doesn't believe in, trying to time the market. He thinks predicting those ups and downs, it's basically impossible, even for the so-called experts.
I see his point. I mean, if even the pros can't really get it right consistently, then, what chance do we have?
Exactly. And he actually tells this funny story about, being in Ireland. During the 1987 crash, he was out golfing. He was more worried about his golf score than the market. He even saw it as like a chance to buy stocks at a discount.
Wow. That's pretty amazing. Talk about staying calm.
Yeah.
Okay, but before you even think about picking stocks, Lynch has this idea he calls the mirror test. It's 3 key questions. Do you own a house? Do you need the money? And do you have, the right kind of personality for this?
Those questions are so important. He's really making you think about, your finances and how much risk you're comfortable with and like your temperament too. He really believes you should own a house first. It provides stability and tax advantages.
Updating your financial house in order first, right?
Exactly. And he's really big on only investing money that, you can afford to lose. No stress, no sleepless nights.
Right, makes sense. But what about the third question? Like, what kind of personality are we talking about? Like, what does it take to really succeed in the market?
Well, he talks about patience, self-reliance, common sense, tolerance for the ups and downs, an open mind, and even, a little bit of humility. It's really about not letting your emotions control your decisions.
Yeah, that makes sense. It's like shifting the focus from, trying to outsmart the market to understanding yourself and having that long-term vision. Okay, so let's say you pass the mirror test. Where do you even begin to look for ideas?
He thinks we've all got this secret weapon, and that's local knowledge. Like, we see great companies and products every day, way before Wall Street does. He calls it our edge.
I love that. It's like we've got inside information, but it's totally legal. So how do we use that? Like to find those hidden gems?
He uses this example, automatic data processing. They sound high-tech, right?
Yeah.
But they actually benefit from cheaper technology.
Yeah.
They process paychecks for companies. And as tech gets cheaper, their profits go up.
It's like finding a diamond in the rough.
Exactly. It shows that knowing what a business really does is way more important than just chasing the latest trends. Lynch wants us to think about what we see every day, what companies are doing well.
Now, to kind of make sense of all these potential investments, Lynch has this system for categorizing companies. He's got 6 main types: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. So why are these categories important?
Well, it's all about understanding what you're getting into, right? I mean, slow growers, they're like the utility stocks, reliable, pay dividends, but they're not going to, make you rich overnight. Stalwarts, they're more like blue chip stocks, those big stable companies that can give you solid returns, but maybe not those tenfold increases he calls 10 baggers.
And then you've got those fast growers. Those are the ones that could be those, 10 baggers, right? But they're riskier.
Exactly. And Lynch really stresses that it's not just about chasing high growth. You got to understand how a company is going to keep that going over time.
So it's not just about speed, it's about staying power. What about the other categories?
Okay, so you've got cyclicals.
Yeah.
companies that, go up and down with the economy, like automakers.
Mm.
And then you've got asset plays. Those are companies that are sitting on, like, undervalued assets that could be, unlocked. And finally, turnarounds. These are companies that are, facing challenges but are showing signs of, like, coming back. They can be really risky but also really rewarding.
So basically, by understanding these different categories, we can start to make better choices about which companies fit our style and how much risk we're comfortable with. Okay, but I'm curious, what does Lynch consider the perfect company?
Well, here's where Lynch gets really interesting. He actually loves companies with boring names, working in really dull industries.
Really? I mean, isn't that the opposite of what most investors look for?
That's the whole point.
Yeah.
A company with a boring name and a boring product, it's probably not getting a lot of attention. That means less competition for us and a better chance to find undervalued stocks before they, like, take off.
I see. It's like finding, treasure where no one else is looking. Are there other things that make a company perfect for Lynch?
Oh, yeah.
Yeah.
He really likes companies that have a niche, like something unique that gives them an edge over their competitors. This leads to, pricing power, and they can make money consistently, even if they're in a boring industry. Like, he talks about this company, Agency Rent a Car. They rent cars to insurance companies. Not super exciting, right? But they really fill a specific need, and they've been super profitable.
So it's about, thinking differently, looking for value where other people just like see boring stuff. Are there any warning signs we should watch out for? Like, what makes Lynch run away?
Oh, yeah, definitely. One big red flag is what he calls diversifications. These are companies that waste their profits on, like, random acquisitions instead of, giving that money back to shareholders.
So watch out for companies that, try to do too much and stray from what they do best.
Exactly. He also says to be careful of what he calls whisper stocks. These are, super speculative investments with great stories, but not much substance. They promise a lot, but, they rarely deliver.
Ah, the classic get-rich-quick trap.
Right. Lynch says to look beyond the hype and focus on a company's fundamentals, especially their earnings growth.
So earnings are really important to him, right? Like the heart of a good investment. He sees them as the key driver of stock prices, doesn't he?
Oh, yeah, absolutely. He even uses this chart of Dow Chemical to show how the stock price basically followed, earnings trends over time.
That makes sense. I mean, earnings are like the proof, right, that a company is actually making money. But how do we actually analyze a company's earnings? What should we look for?
He points to, a few key financial metrics that can give you a good idea of how a company's doing. These include their cash position, their debt levels, their book value, and the PE ratio.
Okay, let's break those down. So what's the cash position and why is it so important?
Well, it's basically how much cash a company has, after you subtract their long-term debt. A strong cash position means they've got a cushion to weather tough times, invest in new things, or just ride things out. Like he uses the example of Ford, how their strong cash position helped them, get through some tough times.
So it's like a safety net for the company, and that gives us, investors peace of mind. What about debt levels? How does debt play into this?
Well, too much debt can be a problem, especially if a company can't earn enough to cover their interest payments. It's important to understand, how much debt they have and how they're managing it.
Okay, and what about book value? What is that? And how does it help us, evaluate a company?
Book value is basically, what's left of a company's assets if they sold everything and paid off all their debts. But Lynch warns against relying just on book value because it doesn't always reflect the true value, especially if they have things like brand recognition or intellectual property. He uses this example of Penn Central, a company with a high book value that, ended up going bankrupt.
Oh, wow. So even with numbers, you can't always see the whole picture. What about the PE ratio? I feel like a lot of investors focus on that one.
The PE ratio, it basically tells you how a company's stock price compares to their earnings. You just divide the stock price by their earnings per share. A high PE ratio could mean, investors are really optimistic about the company, but it could also mean the stock is overpriced.
So it's like, it could be good, but it could also mean more risk.
Exactly. You got to look at their earnings history and what they're expected to earn in the future. He uses this example of McDonald's back in 1972. They had a PE ratio of 50.
50? That's crazy high. What happened?
Well, the stock price got way ahead of itself. There was no way McDonald's could, live up to those expectations, and the stock eventually fell bringing that PE ratio back down.
It's like a reminder to be careful, even with great companies. You can't assume that, just because they did well in the past, they'll do well in the future.
Exactly. The PE ratio can be useful, but you got to look at it, along with everything else.
Okay, so we've talked about finding promising companies, looking at their earnings, and analyzing those financial metrics. Now we got to talk about the tough part, when to sell. What does Lynch say about that?
Well, he gives specific strategies for selling based on those categories of companies we talked about before. Like for those fast growers, he says, look for signs of, slowing growth, more competition, or maybe a PE ratio that's gotten too high.
So it's about knowing when that exciting phase is over and not hanging on for too long. What are some of the signs we should watch out for?
Well, he talks about declining earnings growth rates, maybe their market share shrinking, more competition, stuff like that.
You really got to stay on top of things with those fast growers. What about those stalwarts? When would you sell those?
For those, it might be time to sell if their earnings growth slows down, they cut their dividend, or, if their debt starts to look scary, or if you just find something better.
It's about, always looking for the best opportunity. What about those asset plays? When do you sell those?
He often says to hold those until something happens, like maybe someone tries to buy the company or they restructure and those hidden assets become more obvious. He tells the story about Liberty Corp. They were an insurance company, but they also owned these super valuable TV stations. The TV stations alone were worth more than the whole company's stock price.
Wow, that's amazing.
Yeah. So patience can really pay off. What about turnarounds? Those can be tricky, right?
Yeah, for sure.
He suggests maybe selling once the turnaround is complete. They're back on solid ground and they're growing again.
So it's like reevaluating the situation. Maybe it's not a turnaround anymore.
Exactly. But he also says to be careful about holding on for too long, especially if the recovery stalls or they run into new problems.
It seems like no matter what type of company, he's really stressing the importance of, not letting your emotions get in the way.
Oh, absolutely. He's all about logic,
Yeah.
making smart decisions based on the facts, not on how you're feeling or what the market's doing today.
He talks about resisting the temptation to sell just because a stock has gone up a lot, using the example of Philip Morris. I mean, that stock just kept going up for years.
Yeah, it's a good reminder that great companies can keep growing and delivering value, even after their stock price has gone up a lot.
On the other hand, he also warns against that thinking that it can't go any lower, where you just keep buying more of a losing stock because you think it has to bounce back.
Right. You got to be honest with yourself. Is this a temporary problem or is there something really wrong with the company?
It's about, staying realistic.
Lynch is all about doing your research,
Yeah.
Being flexible and making those smart decisions.
Well, that's a great overview of, the basics of Lynch's approach.
We've covered a lot.
We've talked about finding good companies, different types of stocks, looking at those financials, and even how to manage our portfolios.
And the art of selling, which can be really tough.
But we're just getting started. We've got more to dig into, in One Up on Wall Street. So stay tuned for part 2, where we'll really dive into those specific strategies for picking winners and, building a portfolio that can handle anything. Welcome back to our deep dive into Peter Lynch's One Up on Wall Street. So we've covered a lot of the, the foundation, long-term investing, those categories of stocks, right?
Yeah. All that stuff about, tuning out the noise and focusing on those company fundamentals and those red flags, too, those diversifications and, what were they? Whisper stocks.
Right, exactly. So in this part, let's get into the, the how-to. Picking winning stocks. Lynch is all about using, what we see every day to find an edge.
I love that about his approach. He's not stuck in some office somewhere. He's out there talking to people, observing stuff, using all that to find good investments.
He's got this great story about La Quinta Motor Inns. He first heard about them from a competitor. The guy was basically getting crushed by La Quinta in some markets.
Wow, talk about firsthand information.
Oh,
So
yeah.
that really caught Lynch's attention. And he did some research and realized that La Quinta was, onto something. They were targeting business travelers, value-priced hotels near business districts and all the amenities business travelers need.
It's a perfect example of how paying attention to what's happening in an industry can, lead you to some great finds.
Totally. Lynch wants us to think like, detectives. Use our own observations as a
Hmm.
starting point. He even says, like, think about the companies you interact with every day. What stores do you go to? What products do you use?
Yeah, it's like, don't underestimate the power of just like your own experience.
Right. He's like, what companies are doing well in your world? What makes them special? Are their earnings growing? That's where the real detective work starts.
Okay, so we've got some, potential ideas. What's next? How do we research those companies?
He's big on understanding the company's story, like dig into their history, their products, their management, who their competitors are, all that stuff. Really get to know the company.
Okay, so where do we go for all that information?
He loves annual reports,
Hmm,
company newsletters, industry magazines, even talking to management, industry experts. He's all about getting information from lots of different places.
that sounds pretty thorough. It's like you got to be, an active investor, not just sit back and watch.
Exactly. He wants you to roll up your sleeves and really dig in. He even suggests going to visit companies in person. He believes that getting a feel for the place, observing the culture, even paying attention to little details can give you valuable insights.
Yeah, he tells these funny stories about visiting companies. Remember the one about Taco Bell? He was so happy to see their headquarters was like tucked away behind a bowling alley.
Oh, yeah. He saw that as a sign that they were, frugal,
Mm.
focused on efficiency. They weren't wasting money on fancy offices.
And then there was the time he visited Chrysler, right? He was impressed with the cars, but what really stuck with him was that the executive parking lot was half empty.
Another sign of, cost cutting. These little details, they can tell you a lot about a company's culture, how they think about making money.
It's like using all your senses, right? Not just
So,
relying on numbers.
exactly. And speaking of getting up close and personal, Lynch is a big fan of talking to company management. He says, like, don't be shy. Reach out to investor relations, even the executives. Ask tough questions about their strategy, their challenges, their vision for the future.
Yeah, that would be amazing. It's like getting the inside scoop, straight from the source. Does he have any like specific questions he recommends
Oh,
asking?
yeah. He gives a whole list. But they're all about, understanding their growth plans, their advantages over competitors, their financials, their long-term vision. He says, be persistent. Don't be afraid to challenge their assumptions or dig deeper.
Okay, so we've done our research, we've visited the company, we've talked to management. Are we ready to build our portfolio now?
Hold on. Lynch is a big believer in diversification, spreading your investments across a range of companies.
That's right.
It helps reduce risk and increases your chances of owning some big winners.
Yeah, yeah. It's like the old saying, don't put all your eggs in one basket.
Right.
But how many stocks is enough?
He says a basket of stocks, ideally 5 to 10 in different industries, a portfolio that can weather any storm.
So it's about spreading the risk, but also not spreading yourself too thin.
Right. Exactly. He says don't diversify just to diversify. Focus on the quality of the companies, not just the number.
So you're not just picking random stocks from different industries, you're finding those high quality companies and then spreading your bets, to reduce risk.
Right. Lynch's approach is all about careful selection, monitoring your investments, and being ready to adjust based on, changes in the company or the market.
It's like you got to be involved, right? Not just a passive investor.
Absolutely. He wants us to be engaged, informed, and ready to make changes when we need to. But he knows investing can be emotional, right? He's got some great advice on handling those ups and downs.
Yeah, I think that's something a lot of investors struggle with. It's easy to get, caught up in the emotions of it all.
He says, stay calm during those volatile periods. Don't let fear or greed control your decisions. He wants us to focus on the long term. Remember, stock prices go up and down all the time in the short term, but over time, the value of a great company will show up in the stock price.
It's like having that long-term vision, not
Yeah.
getting distracted by the day-to-day noise.
Exactly. And he gives some really practical tips on, how to handle it when a stock you own drops in price. He says a price drop can actually be a buying opportunity. As long as the company is still fundamentally sound, it's like, don't panic. This might be a chance to buy more at a discount.
That's a great way to look at it, but I can imagine it's tempting to just like sell and get out when you see a stock you own going down.
He warns against that knee-jerk reaction. He says, take a step back, reassess. Why is the stock price dropping? Are these temporary problems or are there bigger issues? Think critically and make a rational decision.
So it's about taking a breath and really analyzing the situation.
Yeah. Lynch's advice on handling emotions and staying disciplined, it's so important. He reminds us that investing is a marathon, not a sprint.
And patience, discipline, and a long-term perspective are key to reaching that finish line.
We've covered so much: picking winners, building a portfolio, handling those emotional ups and downs. But there's one more piece: knowing when to sell.
That's got to be the hardest part, right? Letting go, especially when a stock has been doing well.
It is tough. But Lynch has some really valuable insights into the art of selling. We'll dive into those in the next part of our deep dive.
Stay tuned for part 3, where we'll learn how to, make the most of our returns, minimize those risks, and navigate the exciting but sometimes unpredictable world of investing.
Welcome back to the deep dive. We're wrapping up our look at One Up on Wall Street by Peter Lynch, and today we're tackling that big question when to sell a stock. Yeah, it's funny, isn't it? They always say buying is the easy part, selling, that's the tough one. Lynch even points out that it's human nature to hold on to those winners for too long and bail on those losers way too quickly.
Oh, yeah. I've definitely been there. Convincing myself that a stock that's going down is going to turn around any minute, or that, a stock that's going up will just keep going up forever.
Lynch wants us to be more disciplined. He says we should be selling based on why we bought the stock in the first place and, whether that reason still makes sense.
So it's not about picking a price and saying I'll sell when it gets there, or trying to time the market, right? It's more about understanding how the company's doing and if they're still on track to do what we thought they would.
Exactly. And just like he has those different, strategies for picking winners in each category, he has different guidelines for selling too.
Okay, so let's start with those fast growers, the ones with that potential to really take off. When's the right time to sell those?
Lynch says to watch for signs that the growth is slowing down, like maybe more competition is popping up or their PE ratio is getting too high. Remember, people are buying those stocks because they expect big growth. So any sign that, things are slowing down can really hurt the stock price.
So it's about recognizing, when the party's over, what are some specific signs that it might be time to get out?
Well, things like their earnings growth rate is declining, maybe their market share is shrinking, or they're taking on more debt, things like that.
It's you got to be even more careful with those fast growers. Keep a close eye on them and be ready to move if things change.
What about stalwarts? Those good, solid companies. When would you sell those?
With stalwarts, it might be time to sell if, their earnings growth starts to sputter, or they cut their dividend, or their debt gets out of control, or you just find a better place to put your money. So it's about, balancing those reliable companies with the possibility of something better coming along. What about those asset plays, those companies with hidden value? When do you sell those?
Lynch usually says to just hold on to those until something happens that unlocks that value. Maybe another company tries to buy them, or they restructure and those assets become more visible. He talks about Liberty Corp. They were an insurance company, but they also own these really valuable TV stations. The TV stations alone were worth more than the whole company on the stock market.
That's incredible.
I know, right? Patience can really pay off with those asset plays. Now, what about turnarounds? When do you sell those?
Yeah, those can be tough.
Definitely. Lynch says maybe think about selling once the turnaround is complete, once they're on solid ground again and growing. You rode that wave up. Now you got to decide if you want to stay or move on.
So you're basically reevaluating. Maybe it's not a turnaround anymore. Maybe it's something else.
Right. But he also says to be careful about holding on for too long, especially if things stall out or new problems come up.
It seems like no matter what type of company, he really stresses the importance of not letting your emotions get in the way when you're deciding to sell.
Oh, totally. He's all about logic and clear thinking.
Yeah.
Making decisions based on what's really happening with the company, not how you're feeling or, how the market's doing that day.
He even talks about, resisting the temptation to sell just because a stock has gone up a lot. He uses the example of Philip Morris. That stock went up so much over the years.
Yeah. It shows that sometimes great companies can keep growing even after their stock price has gone up a lot.
But on the flip side, he also warns against thinking that, it can't go any lower, or you just keep buying more of a losing stock because you think it has to come back up.
Right. You have to be honest with yourself. Is this a temporary blip, or are there, bigger problems?
It's about finding that balance between hope and, reality.
Lynch is all about doing your research, being open to new information, and making those informed decisions.
Well, that wraps up our deep dive into Peter Lynch's One Up on Wall Street. We've learned a lot.
Yeah, we've covered a lot of ground.
Finding promising companies, understanding the different types of stocks, looking at those financials, and even how to manage our portfolios during those, good times and bad times.
And of course, how to sell, which is, one of the hardest things to get right.
So what are the key takeaways here? What should we remember as we, head out into the world of investing?
Well, first, knowledge is power. Do your research. Second, think for yourself. Don't just follow the crowd. And third, be patient. Investing is a long game.
That's a great advice. Arm yourself with knowledge, think independently, and stay patient. I love it.
And never stop learning.
That's it for this episode of The Deep Dive. Happy investing, everyone.